we're out there. So just want to make sure. All right, we're live. So welcome to Wednesday, the 15th of December, 2021. And the one thing to remember, everybody, is inflation is not transitory. So coming into this, it's a pretty big deal for Jerome. He's going to have to eat those words. And as the Fed now scramble to adjust to inflation that they do not think is just hanging around for a quick bump. So coming into this, I'm sure you've had a full day of listening to all of the talking heads on Bloomberg and Anthony and myself really looking at what is going to be quite a bit of volatility here this evening. But really, we're in the age of not a lot of things making sense. Gold is not really the haven for this higher inflationary environment. Cryptocurrencies are more so. We're having bad data coming out, increasing inflation figures on the CPIs and the PPIs, and the market has generally stayed up, apart from this week. All right, so we looked at this at the pre-US session earlier on. Sorry, I only got that recording up late into the session, but most of the pro traders, if not all, were actually on live with me while we were looking at that market, or looking at these markets. So we've pretty much almost come down to targets on NASDAQ and SPOOs. Dow, we've hit our we've tested into an important area earlier on. But really, what we're going to get from Jerome on this, we're going to get at 7 p.m., we're going to get the statement from the FOMC. This is going to give us the flesh on the bones of the expectations are here that they are going to half their, double down on their tapering. So I think they're down to 30 bill, in the bonds now. They're going to tighten up on that even more so at this meeting, looking into Q1. Then we also have expectation that they're, instead of having the rate rises coming in for Q3 or 4 2022, there's actually a bit of a concept here that it could be pulled all the way up into Q2. So I have a graphic here, which actually Anthony had this morning. You know what? I actually don't have the graphic here. It's not. Oh, yeah. Okay. Well, actually, sorry. No, I don't have a graphic, but I have some text here, right? So basically, let me just see if I can pull this up. No, I'm not going to be able to pull this up. All right. That's a complete failure. Anyway, really, we're bracing for a hawkish Fed. All right. So we're going to be ready for them to be tightening up. And if that's the case, under traditional sort of the way that I traded these things in years gone by, is really, that's downside for equities, up for gold, mainly up for dollar. Commodities don't largely really care that much. And the bonds, you're probably going to see appreciation in the bonds. That is what we would normally see. However, we're not seeing buyers on gold. We're going to look over that in the charts now in a minute. 9 minutes to the statement now. We haven't seen gold being that great trade. In fact, I think it is officially one of the worst trades, if not the worst trade of 2021. We have really, Omicron coming into the picture. The Fed can't really go straight to tightening. I mean, I heard Jonathan Farrow earlier asking a guy, are they going to do a rate rise this evening? I think that was a bit tongue in cheek, but I doubt they're going to do that. If they did do that, and I put it at like a 1 to 2% probability, that would be a major upset to these markets, and that would be sort of the black swan event in a way, as terms of these meetings go. You're immediately going to see you're down 2% across on equities. The dollar is going to absolutely scream. The euro will get absolutely crushed, and the bonds are going to go skyrocketing. That's not going to happen, though, from my estimation and from most people's estimations. What we are likely to see is the further tapering of bond purchases, and then hinting soft language around rates rises earlier rather than later. Now, that's all fine. And, but what could we expect to see on this? What's the trade, Tim? Well, the trade is not really that simple here. I mean, generally, you got to go with trend, which has been, we're going down all week on equities. All right. Oil is pretty much arrested on the downside and the upside at the moment, paralyzed in around 69s to 71, 72s. The bonds are slightly elevated, I would say, over the last week. And the dollar is pricing in risks here. So, I think for me, the simpler trade to look to is the currency trade on the euro, on the dollar, on whatever your dollarized pair is, whether it's Kiwi dollar to USD, whether it's yen, that's up to you. But I think that's probably going to be the simpler trade. Trying to nail an equities trade here. I mean, look, the reaction could be quite dull. I don't think it will, though. Anyway, 6.5 minutes now until the data. So if anyone has any questions, please do send it in. Ollie, straight off the bat here, evening. What would be bad for oil? What would be bad in the context of the FOMC? Is that? Yeah. What? I don't know. I mean, oil has a lot more on its mind than the goings on at the Fed, to be honest. There's a lot more going on for oil than interest rate decisions, this, that, and the other. If this was kind of 10 years ago, and we were, in an environment where you had high priced oil and a lot of leveraged drillers at work, well, a rise in the interest rates is going to have a really bad impact on their finance facilities, i.e., the money that they're loaning to stay drilling, right, or the money that they have loaned to stay drilling and continue drilling over the next medium term for them. A rise in the interest rates of 2 to 5 basis points, or 0.25 to 5 basis points, is going to be very significant, and therefore it could be a bit of a shocker on oil, and actually a small but temporary lift, if anything. But we don't really look at oil when it comes to FOMCs. We look at currencies, we look at bonds, we look at equities. We look to gold. For me, I'll just be interested to see how gold trades here. So a quick run around the houses, 4.5 minutes left, and I'll share my screen. Sorry, hold on, that's the wrong button. All right, this screen you're all familiar with. And so where do we sit? I'm really just going to get the currencies out of the way. First of all, here is the euro on a weekly chart, trading 12,840s at market. So you can see on these weekly bars, we're really, in the doldrums over a period of the last kind of 6 years here. Quite way down on generally this COVID. Dollar is just, this dollar is just, it just makes no sense how it's so strong, but nonetheless, here we are. The excess on the lows about a month ago here in the week of the 11th, or sorry, the 22nd of November. About a month ago. Nice longs here, but really then stalling out on the rebid back up the ladder towards the 14,955s. And if I go over to the Dixie to give you an idea there of what's happening on the weekly, well, the Dixie has a whole lot of headroom here. All right, a whole lot of headroom to run. It's also come into a compression area here like this, pretty much. And so we exit these areas the way we come into them, which is on the way up, right, in this case. So I firmly believe in a stronger dollar here. Target upside 97.69s. We will switch over to the squawk now in about 2 minutes. Cable, look, I think cable isn't the best trade to be had on this. Gold, looking at where we sit on the gold chart here. Again, we just can't hold higher prices. 1800 is sort of a midpoint. For me, it's actually 1782s. I think, look, target 1758s on the downside, almost there now. We've had this target pretty much for the last 2 days on gold. Any further downside volatility and upside in the Dixie, you're going to see gold crushing through this level and headed south to probe what I think will be, well, at least down at the 1741s. All right, so that's gold. Any upside to this, you're going to find a stop and a turn at the 1758.5, and then we're going to go up. I don't fancy that trade. Nasdaq, really, let me get onto the SPOOs here on the daily bars. So we were looking at sort of a rounded top here earlier in the pre-US session. Some key areas to come involved here. Just get rid of some of these. I mean, this 50 EMA sitting down by 45.84s on the SPOOs. It's looking like it just needs to trade there before it goes higher, really. I mean, that's all it looks like to me. There's a trend as well to take note of here down to bottoms. I don't know about this trend. I'm going to leave it on for now, just very light, and see how it trades. But look, I don't think we're talking about that downside volatility today. I think the max we'll get is 45.84s. All right, 15 seconds until I want to hand a clean minute over to the squawker. Just let me get this on. Couple of questions coming in here. Alan, what would it take for a positive reaction for the markets and a weakening dollar? That would say that they're not reducing, or they're not increasing the tapering, and that they're really pushing out the idea of raising interest rates to 2023, for example. That would be super dovish, right? Super dovish. But if you don't hear anything about, bringing forward the interest rate timeline, then we're definitely, if we don't hear that, I think the market's going to take that as dovish. So just let me switch on Squawk here, and hopefully you guys can hear it. Guys, can you not hear the squawk? All right, the squawk has been feeding through. Sorry about that. All right, sorry, it's on for the feed. Just let me get my feed up here. Sorry about this. So look, it's basically coming in as we thought here. Hold on a sec. Extreme.
Yeah.
All right.
So yeah, just seeing immediate strength in the dollar here on the back of that, alongside downside in treasuries, and also downside in stocks. Typical hawkish reaction here. Again, did get that doubling of the asset purchases, had been expected by many, but again, that would be concluding in March. And she's going to the 2022 dot, that was risen to 0.9% from prior 0.3%. And so that 2022, that does imply 3 hikes for next year. That was the hawkish risk going into this meeting. And that is up from the one priced in at the previous SEP. So again, looking for 3 hikes in 2022 on these current median dot plots.
Right, so really what you're seeing here is mainly that dollar strength.
And again, did see inflation revised higher as expected.
Dollar up. Gold is putting up a pretty decent fight now under this assault from the rising dollar. Euro, I haven't managed. I was talking about getting on this trade earlier. I haven't been able to get on that. Just really paying attention to the squawk here. So I think this volatility and directionality can continue through here. Just seeing a little bit of momentum drawing up on the Dixie. And I would expect the Dixie to hit on target now and keep going. Actually, we have this 96 93s as a target, but this is sort of an interim level. Now the equities the buyers are on these equities here. The Dow is being quite resilient, I have to say, and starting to rise now as well. So it's kind of taking this, even though we are quite hawkish in a way, it's kind of priced in, right? It's kind of priced in. So if you're now trying to sell down on these markets on the back of this, you know,
let's have a look at the M24 dot at 2.1%. That is up from the prior 1.8%. That would imply 8 hikes throughout the forecast horizon, up from the prior 7 and the September SEPs.
So you're seeing pretty decent reaction from equities here. Oil, nothing. It's just on my screen, but it's actually kind of slowed down quite a lot. But yeah, here we go. You know, to the upside and beyond. I think these markets are taking this as a signal that you know what, we still have a supportive Fed, and you know what, the rates rise increase is where it was before this meeting. It's down there. Q3 2022. So that's it really. You know, running commentary for Bernie. Well, you've got it now. So the Dow on the up, Nasdaq as well. Definitely gonna get over the hurdle that was pivot here by the looks of it.
Equities have seen a reversal now, taking a leg higher in global indices.
So you're seeing a reversal now on the Dixie, down below R1, Euro back above S1, cable absolutely murdered. Really big flush out on gold on the lows there, below S1 now. It's above S1 now. So quite a bit of liquidation on gold. Flushing through that 58.5 level. I think there's nice conditions to kind of run a little bit on these equities and kind of get up out of the range that we were in today. So pay attention to the ranges now that we were in all day today. And guess what? I think we're going to smash them here. All right, so SPOO's already at that point, pipped into it. Now, is it gonna trap a whole load of people on the longs buying for a breakout here, which is really not a good strategy if you are buying a breakout there. Right, it's in the top of that range, pushing, and Dow has already run for it there. Dow's made a run. SPOO's is gone. Only a matter of time now for the Nasdaq to push through that range, but it's got to hit in the 16,000 level, and that's not a small level. So we really need to see if traders want how I suppose how much of this is priced in. You know, how much of this is priced in. Oil, just for the oil traders, is holding that gap fill area on the bid. 70.35s on the low on the last candle, and it's going bid. I don't think there's a decent trade to be initiated on gold at all for between now and the close on the pit. Cable holding at the S1. So I'm involved in a little Dow situation here. It's quite fluid. Actually got to take some sausages off the butcher's table here. And
just headlines pointing out that Marcus implying that traders see a 74% chance of Fed hike in April and 100% chance in May after the Fed statement. So it's like fully priced in for a May hike after the latest FOMC decision.
I'm just getting it now that it's fully priced in for a May hike after the decision. A May hike. So that's Q2 hike. Wow. Okay, so it's not Q3, it's Q2. And these markets are still strong. I mean, is there anything that these markets can't do? I ask you. Okay. Just want to recap on this anyway. All right, so we have about 23 minutes now until J Powell gets up here and gives us what we want. He's going to read the statement, and then we're going to go into a Q&A with him. All right, so just let me recap on this here. Okay, so just going over the highlights here, the tapering pace is now at 30 billion, previously 10 billion. 10 billion on treasuries and 10 million on treasuries, 5 billion on mortgage-backed securities, MBS. Tapering end is March 22, previously June 22. All right, so March, April, May. So they're cutting the tapering, and then a month later, they're looking at interest rate rises. Okay, and then taper guidance, the language was unchanged. Prepared to adjust the pace of purchases if warranted by changes in the economic outlook. So that's where they're just covering their back. You know, if, for example, Omicron came out, if the Omicron situation, really raised its ugly head from where it is now, we got into a bit more of a serious situation there. Well, they're obviously maintaining their ability to scale that back, or to scale back the tapering. All right, WTI on high of day here on the pivot, 70.74 trades. Not much going on there. It's really just continuation of really what happened there about just before the DOE actually. Obviously, we had that.
Just as the dust settles in terms of the market reaction, dollar is off its recent highs post the decision. Equities have bounced from the lows and now actually positive territory. Treasuries also off the lows here.
Yeah. So really, I think what the Fed have come out with here was pretty much priced in. The tapering, the tapering end in March instead of June, is an adjustment, and that's it really. So because that's priced in, downside is being capped, and you're seeing equities now taking all that. Right, look at the Dow here, it's taking all that. And then look at the Dow on the weekly. We had a fib level on this. We'll actually get rid of that here. We'll get rid of that. So look at that. We bottomed out 35,340s earlier on today. Came down to that target. Yesterday we came down to that target. Today pushed down on the open. Went a little bit below on the S1, and then we've been holding the bid ever since. And You know what? Are we going to get 35 820s? I don't know. I mean, this is definitely one last swan song for the markets before we go into the final quarter. But one thing, or we finish off this quarter, but one thing to be aware of is these equities contracts we're trading. We're trading the H22. This is the March 22 contract, right? Up here, top left of your screen. So basically, this contract is deliverable before the rate hikes. Okay, that's really important to understand. Okay, I don't have the calendar spread for, or the calendar contract for the June M22 contract, but I would say that there's kind of a nice little spread to be had between those two right now. You'd be long on the front, which is the H22, and you'd be short on the back. Or you could just be long on the outright, which I mean, it's absolutely lovely trading conditions to be long here, to be honest. So that's just something to be aware of, right? Something to be aware of. Okay, so just kind of filling airspace now. So let's, there we go. Let's get back to the overview here. Goals, yeah, flushed out. Holding up now. Dollar down again. So it'll be just interesting to see if we get a second bite opportunity at this euro short once Jerome starts speaking. My apologies for the squawk not being live. I just hadn't adjusted it to the Zoom audio feed. All right, gonna get fed live up here. Yeah, you're seeing the Dow ripping here with this brothers and sisters. Nasdaq up through that high on day. Same on SPOOs. Can we get further up here? I'm pretty sure we can. 35 820's target on the upside in the Dow. It's a big one, but let's see. I think we could definitely do 35 679s anyway. So that's going to put us up just above R1. All right, we got about 14 minutes until Jerome speaks now, so just going to leave that off. Okay, anyone got any questions, queries, thoughts, feelings at the moment? How's everyone doing? Fantastic. Everyone's dead, managing a trade. Shout out to YouTube. What's going on? Oh, Rob, you got the booster. Well, good man. Oil is happy. Oil is happy, Ollie. Yeah. Are you happy with oil? That's the question. Does oil make you happy? Sometimes. Yeah, well, join the club. Well, I've prepared for this. The Guinness has been chilling. Thank you, Ollie. 16,000 trades on NASDAQ. Shorts for the brave. It's looking a bit of a standoff, isn't it? Might go down to a 15-minute here and let's have a look. Yeah, the Dow is pulling back a wee bit off the highs. Yeah, definitely indecision up the top there. So, as I said, shorts for the brave. Absolutely. The risk reward off of that level, if you can hold the short off of that level and we start to peel off and price in the rate hikes and price in, coming rate hikes 1 month after the expiry in this contract, sludge it. Well, you're in a big trade there. You're in a very big trade, very, very big risk reward. Once it touches your lips, really, that's it. Bernie, big question there from Bernie. What will nat gas do in the middle of this? Well, let's have a look. I mean, nat gas has got a lot going on, really, Bernie, at the moment. I mean, um, there is a lot to price into the nat gas picture. See this, we still have not been able to hold trade in the gap fill area. Mega push there. Well, hold on a second. Yeah, it's probably filled on the tail. Yeah, but not where the actual market opened that day. Or sorry, closed that day. So yeah, it's done a good job here, but I wouldn't be comfortable selling that gas given the situation in Russia and Ukraine. Really would not like to do that. You could easily see European buyers then have to kind of go to the nat gas contract and find themselves some energy there. But you know we're holding certainly above 3687s, holding above the midsummer highs right now. There's talk of whether the European winter is going to be warm or cold. The pull down we had here was definitely from weather reports that we're going to have a mild winter in Europe, or certainly a mild start to the winter, certainly the last mile of this. But now, you're getting reports that actually it's not going to be that mild at all. So, you got to do your own due diligence on those weather reports. IHS Markets is pretty good. That's Daniel Jurgen's firm. He kind of is a global expert on energy. I mean, short answer is who knows, Bernie? Who knows? All we have here is our technical eyes of the gap area is just not able to hold. Look at this all day, holding in here, holding on the trend, can't do it. Down she goes. Now we're struggling to get even hold in the gap area here. And it's very hard to sell down on that. Like, so yeah, that's nat gas. We'll go down to a 60-minute again on nat gas, and then we'll pop that one away. I think dollar is looking pretty serious here. Sorry, get rid of that gas. Now the Dixie, just to look at the Dixie, lovely reaction on the 16,000 there from the Nasdaq, and really not to be understated whatsoever. That a test on this 16,000 is pretty mega. What we're looking at here are weekly bars on the Nasdaq. So you see, we just kind of came back up, tested the 16,000. So I tell you what, if we're starting to downtrend, holding the lows of the week currently are pretty important, right? Otherwise, if we breach, say, last week's low, well, you're kind of getting into a situation where it only has one more support, and that is this trend, to be honest. So yeah, definitely very tight action on the Nasdaq in the 15-minute bar chart there. I'll go back to 60 minutes just so we can see everything. Now oil, just I know we're not too focused on oil here, but oil here on the daily. This is our trend from the lows of the 2nd of November last year, touching off the lows of the 23rd of August this year, and then you see the resulting trend mid bottom on your screen here. So it's really a bit of a knot of an area for oil, I have to say. I'm not trading against that level though, but just I like to have it just to see what's going on. Wow, the shorts on the 16,000. Ollie, did you take it? Of course you did. Or did Bernie step in and take over on that one? Oh, Bernie's in that gas bug now. Okay. Or no, Rob. Yeah, well, Rob and Bernie. Equity's really pulling back here. This is deep. All right, I'll switch on Jerome now once we get going. Bottom left of your screen. I'll save you the desperate music the FOMC have as they're holding music. All right, I'm going to cut the squawk and we'll just have Jerome.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1.25% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion
All right, here
for
comes the
agency
Dow
mortgage-backed securities.
coming at you. Check
If the
this
economy
out.
evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month. implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you, Mr. Chair. We'll go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions.
Come on, Rachel.
The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment. And there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So as I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment. And you see that of course, in some of the factors that I mentioned.
Great, thank you. Steve at CNBC.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a
Dow
slower
is really
pace,
strong.
address
Really
the
strong.
current inflation problem? Won't the impact of today's changes
This is going
not
to take
really
a
have any
really
impact
decent
for
spin
6
here
months
now.
or a year down the road on
Target
the
Dow
current inflation problem?
35,690s.
Actually lengthening that time by continuing to buy assets such that it could be not until the long and variable
Sorry,
lag after the end
679s right
purchases
now.
sometime in March
679's
that
target.
you'll start to have any impact on the inflation problem.
Next target, I should
on
say.
the first part of your question, which is why
R1
not stuff
630.
pricing
So
out, I would just say
I
this:
wouldn't
we've
discount the
learned
R1,
that
but
we're in dealing with
quite
balance
a bit
sheet
of
issues,
excess
we've
there
learned
at that point
it's
as well.
best to
See
take
that?
a careful, sort of methodical approach to make
See that little
adjustments.
knot of an area
Markets
there
can be
on the
sensitive
Dow.
to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen.
Shouldn't pose a significant problem, though.
You know, the question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of, a year or 18 months, shorter than that rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was, I think, fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a
Just
question
watch out
of,
now on those
of having to
shorts
wait.
on the Nasdaq. All right, just be careful now. It's going to take another assault, and I don't know if it's going to hold for the short side. Okay.
Of the committee that you will not raise rates until the taper is complete? Thank you.
Yes,
SPOO's target
sense of that, of course,
46.59 is
being that,
upside. Well,
buying assets is
46.63
adding accommodation, and
we
raising
could
rates
definitely
is
get back
removing
up into this
accommodation.
range here.
Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
So we haven't made any decision of that nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the way the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Tamaros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year, and if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020, and I think early on the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different, and the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%.
I'll just bring down Jay there for a minute. Yeah, so the Nasdaq, even though it's holding on the 16,000, it's these equities are still pretty punchy right now, and it feels like there's just another mile left in the push here. Dow's got quite a bit to do on the R1. The SPOOs, thinking back on this yellow area up here, this is actually quite a significant area of congestion above in yellow. So for me, if we can get back up into this yellow area, new all-time highs by the end of this week, I think. If we are resistant on 16,000 and the basically R1, I'd say, on SPOs. I think we're gonna get back to some like 2-month lows. And you're going to have a lot of people saying, well, it was obvious, we're always going up, it was always priced in. Fine. Well, if that's how simple trading is, fine. But yeah, I don't know. if this is the dip you're buying, I don't think you're going to be trading more than 3 days a week, 2 days a week. Back to Jay.
Recently about risk management. And so does that mean that the committee might feel compelled to raise interest rates
See you, Halloween.
before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring, on top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that sort of that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. we'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a sort of from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings,
I like
you're
this guy's
comfortable
questions.
the economy can handle it without quantitative easing.
Yes. Yes, I think if you look at the state of the economy,
Oh, really being put to Jerome there.
That's
a good question.
Demand, the strength of just overall demand, the strength of demand for labor. Look at inflation. Look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do. And I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
That's a good question.
Hey, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Sure.
Gina in with the big bat there.
And, it's been a continual process, really. Inflation really popped up right in the late spring last year.
He is going to squirm on this one.
It was very, very widely held in the forecasting community that this would be temporary. It was quite narrow. A limited number of factors were causing it, and there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month. Monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. We moved the taper forward, and it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the Employment Compensation Index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report and revisions to prior readings and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today, as you can see, unanimous vote, but beyond that, I think widely supported this move.
If I could
Good
just follow
question,
up quickly.
Gina.
You noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation, and how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and then unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our.
Okay. So really, that's the significant part of that done there now. Really, yeah. I mean, round of applause for Gina pinning him down on the transitory comment. Gina's significant other, I'm sure, is paying out a bet there on whether she would or would not pin him to that term. It's got to be pretty well known in the marketplace that he is slightly, if not fully, embarrassed by that whole transitory comment. Anyway, what you do really about nothing, although a lot of significant volatility on the dollar, washing out entirely on the top and then printing low since the statement came out. So a new low since the statement came out. So NASDAQ totally, up to the 16,000, down we go below pivot, and then surging back up to the 16,000, taking out any stops. And I do entirely think that these equities are holding quite well and have new highs before the close on this session dialed in. So yeah, that's it really. The currency trade I wanted on the euro, actually, I didn't even get a chance to get it. I should have been hitting it actually. 7 o'clock on the dot was the best trade to be had there on the short side on the euro. And then it completely unwinded, and it's actually above where it was when the statement hit the tape. I think the euro now, though, we are going to see lower lows over the course of tomorrow and Friday. Who knows, though? Who knows, right? We have to see. We have to see how these markets digest on the close, and indeed tomorrow's session. So that's it. If you are watching this on a recording, feel free to check us out in the Discord room. Just go to duggancapital.com. To all of the lads who've been on the call, brilliant. Thanks for coming along. I hope you've had a good one. And right now I am off to have some dinner, and I'm long the Dow. My favorite thing to do is be long the Dow Jones Index. All right. See you in the morning, boys. Have a good one. Cheers.